Okay, I think we finished this, right? The audit risk model, is that right? Okay, so let's just finish up this chapter. Okay, so these last two slides are just trying to pull together everything we learned. How does it work in a real audit? So materiality and tolerable misstatement. I think we've used the term tolerable misstatement before, right? What does that mean? The amount of error you're willing to allow. That's right. So it's the equivalent, the audit equivalent of materiality. How much error are you willing to allow? So here's an example of how it might work in an audit. Your client, company X, their net income is 36 million. And you set total tolerable misstatement at 1.8 million. So that's 5% of net income. That's where your firm sets tolerable misstatement. And tolerable misstatement per account is $900,000. So half of the 1.8 million. That's how you set it per account, just for an example. Then let's say you're going through, you obviously, on all audits, you will find errors. Nothing's perfect. You're talking about millions of transactions over a whole year. There will be errors. It's a matter of how big these errors are. So these are the errors you found. There was a sale that was not recorded in inventory and cost of goods sold. So they recorded the sale, but they didn't do debit cost of goods sold credit inventory. That was for 312,500. An unrecorded purchase of inventory. So they bought some inventory, but they forgot to debit inventory for it. That was 227,500. And an unrecorded sale at year end. The sale happened just at the end of the year. They didn't get around to recording it until January. And that was 79,500. You add all of these together, it's about $600,000. Okay, 600,000 is less than the total error you're allowing of 1.8 million, and each account here is less than the 900,000 per account. Okay, so that means that these errors are within tolerable misstatement. So what you're going to do, you will still take these to the client, even though they're immaterial. You'll take them to the client and say, I found these errors, you should fix them, and hopefully they'll fix them, no problem. But regardless of whether they fix them or not, the financial statements are fairly stated. There are no material errors. It's within your tolerable misstatement, so you can sign off on these financial statements. All right. Everybody follow us on that. All right. Okay, now trying to put together some of these terms. We just learned detection risk. What is detection risk? Yeah. What's detection risk? The auditor's work, how much work the auditor has to do. Oh, while we're at it, what was the main insight we took away from the audit risk model? What did we say? What's the key insight you want to take from this? Okay, low control risk leads to high detection risk. And how can you translate that just into regular terms? What does that mean? I can't hear you. What is more work for the auditor? Low control risk means they have good controls. There's less of a chance or there's little chance that the controls will fail to catch a mistake. These guys have good controls and they catch the mistake. So the risk of the controls failing is low. If control risk is low, detection risk can be high. And high detection risk means less work for the auditor. And just the opposite. If they have high control risk, meaning they have poor internal controls, there are a lot of mistakes that get through the internal controls. That leads to low detection risk, which means more work for the auditor. Okay, so that's the key insight you take from the audit risk model. If the client has good controls, less work for you, easier for you. They have lousy controls, more work for you. I don't know if I told you this part, but you can think of it as you can advise your client this way. If you tell them, I think you should invest in more internal controls, they say that's too expensive. You say, no, not really. If you invest in the controls up front, you can pay me less every year. So it's actually going to save you money. Good controls, less work for the auditor. And that's why we're going to talk about in chapter 5, you evaluate internal controls first and then do the substantive testing. If you decide they have good controls, you can afford to do less work because you have confidence there aren't a lot of mistakes. Everybody with us on that? All right. So then going on with this slide. So we know detection risk is about the auditor's work, how much work the auditor does. Or actually, detection risk means the risk that the auditor will not catch a mistake. Detection risk determines the quantity and quality of evidence you gather. Then the acceptability of this evidence is determined by comparing this evidence to your assessment of tolerable misstatement. For example, detection risk is set at low. What does that mean? Detection risk is set at low. Means that they have more work. That's right. Poor internal controls, more work for the auditor. So in this case, more work means you're going to look at 50 transactions, just to make an example. So you do a lot of work because detection risk is low, and a lot of work for this account means you look at 50 transactions. The total misstatement in these transactions is within your materiality limit. It's within tolerable misstatement. Okay, so you looked at 50 transactions, you found some errors. Those errors are less than tolerable misstatement. Therefore, you have obtained reasonable assurance that there are no material misstatements in the financial statements. Okay, so detection risk determines how much work you do the work, and then compare that to the tolerable misstatement, the materiality level you set. If the errors are less than what you were willing to allow, everything's good. All right, that's chapter 4. We had a bunch of handouts from chapter 4. We haven't done this yet, right? Right. Okay, good. We're going to do this now. So all these should be on Canvas for you. Okay, so first of all, who wrote this? The ASB. How do you know it's the ASB? It's an AU-C, and they also refer here to SAS. So you know these are ASB standards. If they were PCAOB standards, they would be titled AS. Okay, so this is the actual ASB standard on consideration of fraud in a financial statement audit. So what do they have to say? Characteristics of fraud. The distinguishing factor between fraud and error is whether the underlying action that results in the misstatement of the financial statements is intentional or unintentional. Okay, we've seen that before. What distinguishes error from fraud? Intention. An honest mistake is an error. Intentional misstatement is fraud. Two types of intentional misstatement are relevant to the auditor. Misstatements resulting from fraudulent financial reporting, that's earnings management, and misstatements resulting from misappropriation of assets. Misappropriation means stealing assets, stealing cash or inventory from the employer. Although the auditor may suspect or, in rare cases, identify the occurrence of fraud, the auditor does not make legal determinations of whether fraud has actually occurred. Okay, we're going to talk about this later on. We talk about auditor ethics and stuff, but as a general rule, what they're telling you here, the auditor, you are not law enforcement. You're not FBI or the police. It's not your job to decide whether a crime was committed or something. They just want to let you know that. Responsibility for the prevention and detection of fraud. Primary responsibility for the prevention and detection of fraud rests with both those charged with governance of the entity and management. Do you guys know that term, those charged with governance? That means the board of directors usually. When you see that term, those charged with governance of the entity, usually they mean the board of directors. Okay, so that's one thing. The primary responsibility for preventing and detecting fraud is not the auditor's responsibility, it's the client. Management and the board of directors. They are primarily responsible for preventing and detecting fraud. How do they do that? A commitment to creating a culture of honesty and ethical behavior, which can be reinforced by active oversight by those charged with governance. What does that sound like? What's our term? A commitment to creating a culture of honesty. Tone at the top. There it is again. Management sets an example of ethical, honest behavior. Oh, and here I wanted to point this out to you. Efforts by management to manage earnings. So there's earnings management right there. So if you're wondering, earnings management is fraud. It says right there in the actual audit standards, earnings management is fraud. Okay, so that's management's responsibility. What are the responsibilities of the auditor? We already know this part. Reasonable assurance that the financial statements as a whole are free from material misstatement, whether caused by fraud or error. We already know that part. The risk of not detecting a material misstatement resulting from fraud is higher than the risk of not detecting one resulting from error. This is because fraud may involve sophisticated and carefully organized schemes designed to conceal it. Okay, so they're saying here, what's the risk, the potential fallout from not finding a fraud versus the risk or potential fallout from not finding an error? The risk of fraud, not detecting a fraud, is greater because fraud was done intentionally. So it may very well be that there's more of it that you haven't caught, that you're just scratching the surface. An error, an honest error, um, by definition, was just a mistake, an honest mistake. There's no reason to think it was repeated. It was just a mistake. So the risk, I mean, you need to look for both of them and catch both of them, but the risk of missing a fraud is greater than the risk of missing an error. It's a bigger potential problem if you miss a fraud. The auditor's ability to detect a fraud depends on factors such as the skillfulness of the perpetrator, the frequency and extent of manipulation, the degree of collusion involved. What's collusion? Two people working together is collusion. Okay. And they say they'll tell you this in all the fraud books, all the audit textbooks. If two employees are working together, it is much harder to catch a fraud. Okay. All the books will tell you that. When people are colluding to cover up a fraud, much harder for you as the auditor to catch it. Collusion involved, the relative size of individual amounts manipulated, and the seniority of those individuals involved. It is difficult for the auditor to determine whether misstatements in judgment areas, such as accounting estimates, are caused by fraud or error. Okay, we already talked about this. Accounting estimates are where they had to make a judgment call, and it's very hard for you to second guess a judgment call. It's not like a bright line, this is GAAP, this isn't. It's a tough area for you. So when you find a questionable judgment call that they made, like how they're going to depreciate something, the salvage value, it's hard for you to know. Was that an honest mistake or was it fraud? But as an auditor, it's tough for you to know. You probably won't have enough evidence to really know for sure. Audit procedures that are effective for detecting error may not be effective in detecting fraud. This is an important point we're going to come back to. Most of the stuff we learn that anybody learns in a class like this, an introduction to audit class, are techniques designed to find errors, material misstatements. Most of the stuff we learn is not designed to detect fraud. Now, that's important because a lot of people say we should be focusing on finding fraud. Fraud is a bigger problem than honest mistakes. So we should be changing the way we do audits and focusing more on fraud. You remember that's why we did that. We talked about what's one of the new things in 2017 they put in the audit report. Yeah, but that's not what I mean. Yeah, that's also not what I mean. Whether due to error or fraud, right? That's a new thing they put in 2017. They want to emphasize to everybody. Auditor's job is to look not only for error, also for fraud. Okay. But it's part of the same thing. People are arguing auditors should focus more on fraud. Okay. And they're telling you that here, that's a problem. Most of the stuff we're going to learn in this class is about how to find errors, not about how to find fraud. And that's a weakness in how we train auditors. Okay, so then they're giving you advice. How can you look for fraud? The rest of this is about how you can look for fraud. Perform a retrospective review of management judgments and assumptions related to significant accounting estimates reflected in the financial statements of the prior year. Okay, so what they're suggesting you do when you're starting this year's audit, go back to last year's audit, 2 years ago audit, and look at the judgment calls, the estimates they made. How did those turn out? Does it turn out that they are always making over optimistic judgments that end up not working out? Like you told them last year, I think you should take an impairment on this goodwill. And they said, nah, that's not necessary. Then the next year they did have to take it. If you see a pattern of this, they're always being over optimistic. Maybe you stop and think, are they making mistakes or are they intentionally trying to make things look as good as they possibly can? So go back and look at previous audits and rethink now with the benefit of hindsight, exactly how accurate were those judgments. Evaluate for significant transactions that are outside the normal course of business for the entity or that otherwise appear to be unusual given the auditor's understanding of the entity and its environment and other information obtained during the audit, whether the business rationale or the lack thereof of the transactions suggests that they may have been entered into to engage in fraudulent financial reporting or to conceal misappropriation of assets. Okay, so the key thing here, significant transactions that are outside the normal course of business for this company. So this is again why you should know the company, know how they do business. You know what kind of accounting transactions they make. What kind of sales do they make? What products do they sell? What are the contract terms? Who are their customers? You should know all this. If you know it, then you can identify, wait a minute, why are they doing this all of a sudden? They don't normally do this. And that's an automatic red flag. You're going to scrutinize what's this new thing they're all of a sudden doing that they don't normally do. Okay, anything outside of the ordinary should be a red flag to you, something you want to concentrate on. Only if you know what's ordinary for them can you figure out what's out of the ordinary. That's why you need to know your client. An instance of fraud is unlikely to be an isolated occurrence. We just mentioned this. If you find an instance of fraud, you are probably just scratching the surface. There's probably a lot more out there that you haven't found. Okay, here's some good advice they give you. Unpredictability in the selection of audit procedures. Incorporating an element of unpredictability in the selection of the nature, timing, and extent of audit procedures to be performed is important because individuals within the entity who are familiar with the audit procedures normally performed on engagements may be better able to conceal fraudulent financial reporting. Okay, what they're talking about here, you guys might have heard about this already. A normal career track, your first job, you're an auditor with a firm, and then after a couple of years, you take a job with one of your clients. You guys heard of that? Okay, because you come to know the client, you understand their accounting and everything. Nothing wrong with that. That's a normal career track. But that means that when they do the audit next year, you're the one in charge of the accounting for the client. You know exactly how the audit team works. You know how they choose a sample, you know what accounts they're going to look at, you know when they're going to show up, you know everything about how they do their work. So you're in a good position to hide stuff from them. Probably the senior auditor, the controller, the CFO at your client used to work for you. Okay, they know exactly what you're going to do. So, how do you get around that? You need to be unpredictable, surprise them. How do you be unpredictable exactly? This can be achieved by, for example, performing substantive procedures on selected account balances and assertions not otherwise tested due to their materiality or risk. Okay, so they know you normally look at this account because there's not a lot of money in there. It's not a material amount like miscellaneous expense or something. So that's where they're going to hide fraud, someplace they know you're not going to look. So surprise them. look in that account all of a sudden. Adjusting the timing of audit procedures from that otherwise expected. Okay, if they know that you do certain testing at an interim period, they're going to wait till the end of the year to do the fraud. So surprise them, do it at the end of the year instead. Use different sampling methods. They know the software you use to choose random samples, all this kind of thing. So use different software. Performing audit procedures at different locations or at locations on an unannounced basis. Okay, so they know when you're auditing inventory and you go to see the warehouses, they have a big main warehouse and then they have some smaller warehouses. Which warehouse do you think you're going to look at? The biggest one, right? That's where the material amount of inventory is. And they know that. So what are they going to do if their inventory is overstated the night before you show up? They're going to move stuff from one warehouse, one of the smaller ones, into the big one so that the big one looks like there's plenty of stuff there. So what are you going to do? Show up at a smaller warehouse and don't tell them you're coming. Just show up. I'm sorry, I didn't hear what you said. What if they hide? Oh, well, you can't prepare for everything. You want to, like I said, know the business, know what they're doing, and try and plan it. But if they really want to cover up a fraud by hiding stuff someplace they don't even identify as a warehouse and have no paperwork on, maybe you won't find it and they'll get away with something that there's only so much you can do. The auditor may design procedures to obtain additional corroborative information. For example, if the auditor identifies that management is under pressure to meet earnings expectations, there may be a related risk that management is inflating sales. All right, so we talked about this. You need to know your client, what's going on with them. If there are a lot of articles online in the Wall Street Journal, these guys are under pressure to meet their new earnings per share target. If they come up short, the CEO is going to get fired. If they're talking about that, this is a company that's under pressure to manage their earnings. So you know about the news with this company, so you know if they're going to be tempted to manage earnings. In these circumstances, the auditor may, for example, design external confirmations not only to confirm outstanding amounts, but also to confirm the details of the sales agreements, including date, rights of return, and delivery terms. Okay, so instead of just looking at a sales transaction to make sure it exists, maybe you look at more details like FOB shipping, FOB destination, or any rights of return in the sales contract. Any of them go into more detail because you're particularly suspicious about their sales and whether they're going to inflate their sales this year because of earnings management issues. Computer-assisted audit techniques may enable more extensive testing of electronic transactions and account files. Such techniques can be used to select sample transactions from key electronic files, to sort transactions with specific characteristics, or to test an entire population instead of a sample. Okay, you guys have been learning about this. How many of you guys have taken the new Gateway, the data literacy course, instead of the old one? How many of you got to take the new one, BIS 312? Some of you, but most of you took the old one. Okay, well, we've got the new Biz 312, which is all Excel data literacy. So you guys learn lots of good stuff in there. Okay, good, good. Um, anyway, and you guys used I'm blanking on the name. What do you use in 351? What's the software you use? Tableau, that's right. Okay, so you guys are getting exposed to these computer assisted audit techniques. We're going to do IDEA as the second case in this class. You'll get exposed to that. But you guys have seen just what these things can do. They can handle much bigger samples, much bigger data sets. So, like instead of just looking at a sample, you can look at the whole population. That makes it easier to find fraud. Also, there's sophisticated things that this software can do. I saw a demonstration once. You guys remember this from introductory accounting. Whenever you do a journal entry, you're supposed to put a little explanation at the bottom of what the entry was for. So they can search, they want to flag every journal entry that does not have a little explanation at the bottom. And it'll just like that highlight every one of those for you. Those are the red flags that you want to follow up on. Okay, so that's how the new computer assisted technology can help you to do an audit and look for fraud. Characteristics of fraudulent journal entries. Entries made to unrelated, unusual, or seldom used accounts made by individuals who typically do not make journal entries. Okay, we talked about this before. Who should be doing accounting work? Accountants, only accountants. Somebody who's not an accountant should not be involved in the accounting. You see somebody who's not an accountant getting involved in the accounting, that's bad news. They're probably not doing it for a good reason. So people who normally make journal entries, if all of a sudden there are other people involved, that could be a problem. Recorded at the end of the period or as post-closing entries that have little or no explanation or description. Made either before or during the preparation of the financial statements that do not have account numbers. Oh, okay. We mentioned this before, right? So you find out whether you met your target, your bonus, or your Wall Street Journal estimate or whatever at the end of the year. What's the only thing left to be done at the end of the year? The adjusting entries, right? Did we talk about that already? Yeah. The adjusting entries are the only thing left to do. So that is a very ripe area for earnings management. When they find out they didn't get the number they wanted, the adjusting entries are still left to do. So look closely at those. And then this one, containing round numbers or consistent ending numbers. There's some, you guys know a real life transaction is never exactly $2,000. But if somebody's just trying to boost the income a little, they might do something like that. Just write in $2,000. So when you see a lot of round numbers like that, that's a red flag. You want to look closely at that. Non-standard journal entries and other entries such as consolidating adjustments may not be subject to the same level of internal control as those journal entries used on a recurring basis to record transactions such as monthly sales, purchases, and cash disbursement. Okay, most of the internal controls are on the accounts where most of the business happens. Revenues where there's millions of transactions, cash, that's where the controls are. There are not as many internal controls on the accounts that don't get used very much. Okay, like retained earnings, there are hardly any entries in retained earnings. There's not going to be a whole lot of controls for retained earnings. So if you want to hide something, you do it in something like retained earnings, miscellaneous expense, any account where there's not typically a lot of action. Okay, so that's why to surprise people, look sometimes at those smaller accounts that nobody looks at. Risks of material misstatement, including misstatements due to fraud, cannot be reduced to an appropriately low level by performing only tests of controls. Okay, what they mean here, right? We just talked about good controls mean you can do less work, but there is no such thing that's controls that are so good that you don't have to do any substantive testing of transactions. There's no such thing. You always have to do some actual testing of transactions. You can never use as an excuse, I didn't do any substantive transactions because controls were so good, I'm sure there were no mistakes. That is never a good audit procedure, they're telling you. Okay, that's that one. Any questions there? All right. We also have this one. Okay, we were just talking about earnings risk management last week. What's earnings risk management? Not, what am I saying? Enterprise risk management. That's what I mean. Enterprise risk management. What's enterprise risk management? I can't hear you. Right. The company faces, right. The company is supposed to do enterprise risk management, that is identify the risks that they might potentially have to deal with and planning out if these things happen, how are we going to deal with them? That's something the business does, not you, the auditor. Enterprise risk management. So this guy's talking about how do the companies actually do that? Enterprise-wide risk management systems have expanded greatly in recent years, primarily as a tool to help management and the board proactively deal with emerging risks. Some auditors may believe that understanding management's broader approach to managing enterprise-wide risks may be interesting, but not relevant to financial statement audits. Okay, we just talked about that, right? That you might think these big picture risks like immigration policy don't matter to you doing the financial statement audit, but you're wrong. These big things will eventually filter down to the financial statements. That's why you need to know all about your client and the business they do. For instance, risks such as competitor moves, disruptive innovation, shifts in customer demographics, talent concerns, or the impact of geopolitical events may seem outside accounting processes and internal controls that encompass the financial reporting process. Okay, so you might think it doesn't have to do with you. But learning about a client's enterprise-wide approach to risk management can provide rich insights for the auditor's consideration of the entity and its environment, including internal controls that is required for every audit. Who leads the risk management process? Without someone or some group of individuals explicitly focused on designing and implementing a risk management process to be applied across the enterprise, an entity's approach to risk oversight is likely to be ad hoc and insufficient. Do you guys know that term, ad hoc? Anybody? Okay, that's Latin. It means to the thing. The way it translates means you don't have a system. Just as a problem comes up, you deal with that problem. Next problem comes up, you deal with that problem. You don't have a system in place for how to deal with these things. When you have something like that, they say it's an ad hoc approach to dealing with problems. So if you don't have someone in charge, you're likely to be ad hoc and insufficient to effectively monitor the volume and complexity of risks. Thus, evaluating whether the organization has selected a leader of the risk management process may be one of the first considerations auditors want to make. So we already talked about this. You need to see, is this company taking enterprise risk management seriously? Do they have a committee, a plan in place, how to deal with things? If they don't, that's a bad sign. An ad hoc, unstructured, or non-existent approach to risk identification may lead auditors to question whether there is a sufficient tone at the top regarding risk management. There it is again. Management's identification of top risks will contain some that are not directly related to the risk of material misstatement in the financial statements. But evaluating top risks is likely to inform auditors about important internal and external factors that might affect the entity's business model or the success of its strategic plan. That information may in turn identify potential pressures on management that could ultimately increase the risk of material misstatements, including the risk of fraud. So knowing what all's going on in the business can tell you, is there pressure on this management to, for example, manage their earnings? Organization. So here, this guy, what he did was interview a bunch of real companies about how they do ERM, and this is what he found out. Organizations generally report between 5 and 20 key risks annually to the board of directors. Usually, that information is presented to either the full board of directors or one of its committees, often the audit committee. A number of entities are creating standardized risk profile documents in the board's pre-meeting reading materials that provide an overall profile of each risk presented to the board. Those profiles often include an overview of the risk concern, its likelihood of occurrence and impact to the organization, how the organization is responding to each risk, and the adequacy of each of management's responses to the risks, and metrics management is using to monitor each risk over time. So this is exactly what that COSO report was talking about. There's a committee, they report to the board of directors. We identified this is a risk. This is how big a potential problem it is. This is the probability, likelihood of it happening. And this is what we've got in place as a plan to stop it from happening. While the board of directors is ultimately responsible for the oversight of top risks, it often assigns responsibility for understanding and approving management's risk management process to a committee. For most entities, the audit committee assumes this responsibility. Okay. So according to this guy, the audit committees are often put in charge of enterprise risk management. Oh, here's a term that seems to come up a lot. You might see it key risk indicators or KRIs. What kind of things are KRIs? This might be tracking shifts in customer demographics that suggest a migration toward more urban living for a retailer to forecast future new store locations. The presence of KRIs on management dashboards may help auditors in planning or analytical procedures. We just learned that. What are analytical procedures? That's right. Using financial statement ratios to compare a company across time. What was the current ratio this year, last year, 2 years ago, to see if there's any red flags, anything indicating a problem. So they talk about here, it can be used to plan your analytical procedures. In addition to insights they may provide as part of the analytical procedures performed in the final stages of the audit. KRIs often are based on non-financial information, and therefore they may provide additional opportunities for the auditor to develop expectations about financial statement balances or trends over time. Okay, that's that. Any questions there? Okay, 8:02. All right, good time for a break. So 8:17 we'll be back. Okay, back to work. Here's the appendix. Okay, we got one more handout from chapter 4. Okay, so this is about this was written right after the pandemic and was about what auditors learned about technology. All of a sudden, they had to do everything remotely. So what did they learn from that? That's what this was about. Auditors leverage technology lessons from pandemic. All right, so this guy from BDO is talking here. He began working on automating the practice shortly before the outbreak of the pandemic. In November, a year and a half ago, so I think he means November 2019, I got to the technology piece of what we're doing in the audit practice, and I realized we had to rewrite our entire technology plan in the sense that we had to focus on automating our processes. Okay. Oh, it's not on the screen. Okay. We had to work on automating our process here. So it's this article. Yeah, yeah. Okay, so what was I just saying? Automating our processes. So, you guys heard of the term robotic process automation, RPA? Anybody, what's that about? RPA, robotic process automation. Okay, so you find a task that's being done by hand and you can use technology to automate it. So as an auditor, you're not expected to be an IT auditor who can actually do that, but you could identify, oh, here's a process the client's doing by hand, could be a lot more efficient if they automated this using software or whatever they're talking about, and then the IT people will come in and actually do it. That's called automating processes, RPA, robotic process automation. And that's what he's talking about here. We had to answer 4 questions. How do professionals currently use technology in delivering services to clients? How do professionals use technology in working across business lines? How are professionals supported by technology in their internal workflow processes? And how do you automate the process at the engagement level? Last February, before COVID began shutting down offices at BDO, he asked the IT team to accompany audit teams in the field as they audited clients in various industries, including science, manufacturing, and distribution. So the IT auditors shadowed the financial statement auditors to see what was going on. I'm glad I did this in February before COVID hit in March. So we were able to get through quite a few engagements where we actually stopped and watched what the auditors did, interacting with them while they were doing the audits live. After they spent a lot of time in the month of February doing that, they came back to me with a shocking list at the time. They came back to me with 79 individual automations that they thought they could execute at the engagement level. It's over 100 now. We're a 5.2 million hour audit practice, and they thought I could save 1.7 million hours at the time by eliminating the human element and incorporating technology. That's like 30 to 35% of the time we spent on our engagements. My initial reaction was that seems like a lot. But even if they're half right or even a third right, if we can eliminate even 10%, that would be an astronomical savings. You could eliminate 500,000 hours or 800,000 hours from a 5.2 million hour practice by automating. Okay? So they're saying there's a lot of processes out there. You can help the client or even your audit practice by automating them. Okay, and then he goes on to talk about other stuff here. Deterring fraud. Audit firms will need to be careful in how they roll out such technology to avoid abuse and not trust automation to take care of the vital role of an experienced skeptical auditor. Okay, so you guys are probably already learning this. Technology can make it more efficient, fewer mistakes, but you still need an actual person who can make critical thinking evaluations about whether this is working, whether this has found the dangers of fraud or not. The accounting firms and audit firms absolutely need to embrace the fact that we continue to miss these massive frauds using outdated technologies and audit procedures. It's a travesty. The number one thing we need to change is our mindset as auditors. There are far too many auditors who believe that finding fraud is not part of their professional responsibility. Okay, we were just talking about that. That's like in the new audit report where they put in due to error or fraud to remind auditors that they are supposed to be looking for fraud. When you look at the Association of Certified Fraud Examiners' most recent report, they said auditors find fraud about 4% of the time. I've seen studies like that too. That means 96% of the time, we're not the ones finding it. Accidents, on average, find fraud about 8% of the time. So an accident is twice as likely, is twice as good as an external auditor. So they're saying when they look back at frauds that happened, how was it caught? 4% of the time, the financial statement auditor caught it. 8% of the time, it was found by accident. So accidents are twice as effective as the auditor in finding fraud. I think we need to get a lot better at our job, or we risk losing the exclusive right to perform financial audits. Ultimately, I don't think conflict of interest is the driving force of missing the frauds. I think the driving force of missing the frauds is the lack of focus on finding material fraud within the financial statements, not being focused on testing for fraud. He pointed to the recent fraud at Wirecard in Germany. That's a technique where the exact same fraud took place with the Parmalat fraud in 2003 and the McKesson and Robbins fraud in the 1920s and 1930s. They just provided fake mailing addresses. It was as simple as that, and nobody checked the mailing address. We're really not looking at historical frauds, how they happened, and altering our audit procedures in response to those. The fault doesn't lie with the standard setters, he believes. I really think the standards are clear. I think the standards spell out the auditor's responsibility, whether it's the ASB, the IAASB, or the PCAOB. All state that it's the auditor's responsibility to identify material misstatements due to error or fraud. And in fact, it's always been our responsibility. We know that. What the standard setters are talking about is the profession's responsibility to find a material misstatement due to error or fraud, and specifically fraud. I have yet to hear of a multi-billion-dollar error. I hear about multi-billion-dollar frauds all the time. Okay, so this is part of what we said in that the SAS we were looking at. The risk of not finding a fraud is worse than the risk of not finding an error. A fraud leads to multi-billion-dollar losses. Companies go bankrupt, thousands of people lose their jobs, and they're a huge scandal. An error is usually not that big of a deal. Okay, so it's really more important that we find frauds than that we find errors. And we should be changing our audit practices and techniques so that we do that. Oh, auditors need to keep an eye out for cybersecurity risks with the move to remote audit. You guys learned something about cybersecurity, right, in your IS classes? Yeah, okay, good. We've all talked about the use of analytics and the vast capabilities around machine learning and artificial intelligence. What we can see is there are currently early digital adopters who are doing this, and it's being well received to bring those tools and techniques to bear to provide greater insights for organizations to respond to things. Most of us in the last year have continued to be in an at home environment. How do we work and how do we stay in the forefront? Embedding technology is a great example where auditors would test large data sets. Now we can embed those through robotic process automation, what I was just saying, RPA. Okay, that's that. Okay, we got a couple of problems out of chapter 4. Okay, 4.55 on page 161. Okay, this one, it's an important problem. It's good if you have it with you. How many of you guys have the textbook accessible with you right now? Okay, most of you not. It's good if you have it, please pull it up. 4.55 on page 161. 161. You guys see an eraser anywhere? No. On the board. Oh, on the board, right. Okay. That's not an eraser. Oh, yeah, we gotta take it off. Yeah. Okay, so I said the first exam is chapters 1, 2, and 3 in Module C. Chapter 4 is going to be on the second exam. And as I said, the second exam is 20 multiple choice and a longer problem. This is the longer problem. It'll be exactly like this, 4.55. So it's important you pay attention to this. Yeah.
Are you saying your chapters 1, 2, and 3 module C for exam?
For the exam on Wednesday, it's chapters 1, 2, 3, Module C. Okay, so this is using analytical procedures and financial statement analysis to look for red flags. So this is what your problem on the exam will be like. They give you comparative financial statements last year and this year. And you're supposed to compare them using things like financial statement ratios to identify any potential problems. Okay? Now, there's no real system to this. This is just detective work using your knowledge of accounting to see what looks wrong. So one thing you can always look at, judgment calls, we always said are an issue. So one judgment call is allowance for doubtful accounts, right? So why don't we look at that? We got accounts receivable and allowance for doubtful accounts. You got prior year and current year. And what does it say? Last year, accounts receivable was 500,000 and allowance for doubtful accounts was 40,000. That's 8%. Okay, their allowance for doubtful accounts is 8%. Bad debts is 8% of gross accounts receivable. That's how they count. This year, the numbers are 400,000 and 30,000, which is a little less than 8%. 8% would be 32,000. So it's not a big difference, but it's a little off. So in real life on an exam, this wouldn't be a huge one, so I wouldn't really want you to mention this, but just as a first example, if they were consistent keeping 8%, it'd be 32,000. They lowered it a little bit. So you would ask them, why did they lower it? If they have the same customers selling the same products, bad debt should be the same. So you'd ask the client, why did you change this? This would be identifying a red flag. Why did you change your estimate of allowance for doubtful accounts? They might say, we tightened our credit policy, so we don't expect to have so many bad debts. That's a legitimate reason. Or they're manipulating the financial statements to make it look better. But anyway, this could be a red flag. Okay? But as I said, as far as dollar value, that's not really important. There are more important. Okay? Current ratio. We said you do a lot of financial statement ratios with analytical procedures. Okay? What's the current ratio? Go ahead, you guys. Current ratio, current asset over current liabilities. What does that measure? What's the point of that? Liquidity. These are the bills coming due this year. These are the liquid assets you have. Do you have the liquid assets to pay the bills that are coming due? It's your liquidity and solvency. Okay, so let's go ahead and calculate that. You got prior year and current year. Last year, current assets were 2,560,000, and current liabilities were 560,000. And this is, what is it? I think like 4.6, 4.7. Somebody do that. 4.57. Okay, and the current year is 2,794,000 current assets, and current liabilities are 1,400,000, which is 1.99. Okay, so what do you notice there? That is not consistent. Remember, the first thing you're looking for is consistency. As long as they're in the same business, selling the same products to the same customer, these numbers should be fairly consistent over time. This is a huge drop, 4.6 to less than 2. There could be legitimate reasons for it, but this is a definite red flag. Something is going on here. And there's even more to it than that. You go to the next page, a problem, and they give you some notes here. It says they just took out a new bank loan on July 1st, requires maintenance of a 2-to-1 current ratio. So technically, they're in violation of their debt covenant, and their bank loan could be called at any time. So you definitely want to inform the client about that. So for that reason, too, this is a big issue, definite red flag.
That be put in the CAMS section of that audit.
CAM is something you go to the audit committee with. This might not be like that. You don't know yet.
Okay.
Right now, like we said, a red flag is an issue. You go to them and they say, yes, we're aware of that. We're infusing some new cash right now and everything's going to be fine. Okay. If they don't have a good answer and this is a major problem, it could end up being a king. We're concerned about this company's liquidity, something like that.
Okay.
But for now, remember, we're talking about identifying red flags just by looking at financial statements. You don't have enough information just by looking at the financial statements to understand exactly what's going on. You are identifying areas that you want to look at some more. Something looks off, you want to find out what's going on. Okay, these just help you identify areas to look at, risky areas, red flags. Okay, so that's one. Okay, the next thing to look at, okay, look at their bank loan. Go under liabilities, they have 2 loans. They got a bank loan at 11% and long-term debt, another loan at 10%. You got last year, this year. Okay, so the 11% bank loan last year was 0. This year it's $750,000. So what happened there? Took out a new loan. Okay, nothing wrong with that. The other debt, the long-term debt, last year it was 500,000. This year it's 400,000. Okay, so they paid down some debt, no big deal there either. Now, your knowledge of accounting, what's the related account you want to look at when you're dealing with a bank loan?
No paper.
Interest expense. Okay, so let's go down to the income statement and look at interest expense. Okay, last year, interest expense was $50,000. That sounds right. Everybody get the attendance didn't make it over here. Okay, yeah, last year interest expense was 50,000. That looks right, right? They had one loan, 10% of 500,000, 50,000. That looks good. Now this year, interest expense used 40,000. How about that? What are we seeing here? 40,000 is 10% of 400,000. They did that right. But where's the interest from this loan? It says, remember, we just read that note. They took it out in the middle of the year. So 11%, that's half a year's interest. 5.5% of this, that's a lot of money. They forgot to record it all together. They probably know somebody forgot to put in. We calculate the interest on this loan and put it in interest expense. They forgot there's a new loan. We're going to have to do interest expense on that one too. So this isn't even a red flag. This is a definite error. Again, your knowledge of accounting, I'm looking at loans. I need to look at interest expense too. That's a related account. Okay, and then finally, the other big one that comes up here, what's our formula for retained earnings? Go ahead. Retained earnings,
Net income.
there is net income, yep. Beginning retained earnings plus net income minus dividend is ending retained earnings. Okay, so let's go ahead and do that for this year. So this year's beginning retained earnings is last year's ending retained earnings. So that was, what do we got? 1 million. Last year's ending retained earnings was $1 million. Okay. What is net income this year? 294,000. Okay. Dividends. Anybody need the attendance? Dividends, you go to the notes again on the next page, and it says they have never paid dividends and have no plans to pay dividends. So that's a zero. So ending retained earnings is 1,294,000. Okay, now look on the balance sheet. What's ending retained earnings for this year? $1,100,000. They misstated their retained earnings. Okay, so on the exam, I'm going to give you financial statements, comparative financial statements, just like this, and ask you to identify 3 red flags and give a brief explanation for why they're red flags. So you got 3 good ones right here. Current assets went way down and they're in violation of their debt covenant. Bank loans forgot to record interest expense on the new loan. Retained earnings miscalculated. That's 100% answer there. Okay, if you go and well, like I said, this first one, the ADA, technically that's a red flag as far as materiality. It's not really a very good one, so I wouldn't give you 100% for writing that one down. Yeah. Yeah, about. But there's plenty of time. Don't worry. You'll be able to do it. Okay, you go on to the next page. They did more of these analytical procedures for you. They calculated some ratios for you, which you can do yourself on the exam. Okay, and let's look at some of these numbers. Do any of them look good? Or not look good? Do they look interesting? Okay, days sales and inventory. What is days sales and inventory? What does that mean? Days sales and inventory. Yeah. Right. How long it takes them to turn over their entire inventory. So last year it was 86 days, 85.77. This year it's 133 days. So that's almost 50 days longer it took them to turn over their inventory. I don't know what's going on with that, but that is definitely a red flag. Something is wrong. It could be like an economy-wide recession that they can't do anything about, or it could be something wrong with this company. But either way, that is definitely something worth following up on. That's a red flag. Yeah. Or the same exercise on the next page, the textbook already calculated some ratios for you. They're right there. All right. Okay. Now, for you to practice with, there is another problem in the textbook, problem 4.58. 4.58 is another one just like this for you to practice. Before we take the second exam, the second quiz will be a problem just like this to practice, and then it'll be on the second exam. So we'll be doing some review, give you time to learn this stuff so that you can do it on the exam. Yeah, that is 4.58.
We provide solutions for the.
You have the solutions on Canvas, right? Textbook solutions. I posted those, right? Yeah, yeah. So yeah, those are there. Okay, everybody feel good about that? And remember, right now, you don't need to worry about chapter 4, so put this aside after the exam next week, then pick this up again and get to work on it. Um, oh, yeah, okay. The two more problems I want to do, 4.59 and 4.60. 4.59, audit risk model. Audit risks for particular accounts and disclosures can be conceptualized in the model. Audit risk equals inherent risk times control risk times detection risk. Use this model as a framework for considering the following situations and deciding whether the auditor's conclusion is appropriate. Okay, first example. Paul CPA has participated in the audit of Tordic Cheese Company for 5 years, first as an assistant accountant and the last 2 years as the senior accountant. Paul has never seen an accounting adjustment recommended and believes the inherent risk must be zero. Okay, he's been working on this client's audit for 5 years. Okay, he has never seen a mistake. What do you think? How realistic does that sound? No mistakes in 5 years. Okay. This is not the company is great. This is he's not doing a good job of looking for mistakes. There are always mistakes. Even a really good company, you're talking about millions of sales transactions, there are mistakes. Oh, and in terms of the audit risk model, he says inherent risk is zero, no chance of a mistake. There's never no, well, yeah, that's also when they conceptualized it to be good math. Using the math, none of these can be zero. If any of these are zero, then audit risk is zero, means there's no chance of a misstatement, which makes no sense. So none of these can ever be zero. They can be low, they can't be zero. B. Hill CPA has just completed an exhaustive study and evaluation of the internal controls of Edwards Foods. Hill believes the control risk must be zero because no material errors could possibly slip through the many error checking procedures and review layers that Edward used. Okay, once again, control risk cannot be zero. They can have very good controls, low control risk, not zero. There's always a chance of a mistake. C. Field CPA is lazy and does not like audit jobs in Philadelphia. On the audit of Philly Manufacturing Company, Fields decided to use substantive procedures to audit the year-end balances very thoroughly to the extent that the risk of failing to detect material errors and irregularities should be very low. Fields gave no thought to inherent risk and conducted only a very limited review of Philly's internal control system. Okay, so this guy didn't consider controls or inherent risk. He just did a lot of substantive work. Okay, what do you think of that? Okay, the other way around. They'll be doing less work. That's exactly right. So this guy calls himself lazy. He's not lazy. He's inefficient. If he took the time to look at the controls, he might find they have very good controls and he doesn't have to do a whole lot. If he followed the audit risk model, it might be a lot more efficient. He could get it done a lot faster. D, Shad CPA is nearing the end of a dirty audit, in quotes, whatever that means, of All Night Protection Company. All of All Night's accounting personnel resigned during the year and were replaced by inexperienced people. The controller resigned last month in disgust. The journals and ledgers were a mess because the one computer specialist was hospitalized for 3 months during the year. Thankfully, Shad thought, I've been able to do this audit in less time than last year when everything was operating smoothly. He says he did the audit this year in less time. No, it's just the opposite, right? First, all their accounting personnel left. Well, we said there are two bad things about that. What does that tell you? All the accounting people left. Two bad things about that. Yeah. Right. One thing, tone at the top. This is a bad work environment. People want to leave. That's the main thing. Also, it means they got inexperienced people working there, which means more mistakes. So for both those reasons, this is going to be a really difficult audit, not an easy one. Yeah, and the IT person was hospitalized for 3 months. That's another reason why controls are probably going to be bad. Okay. All right, one more, 4.60. Okay, this is interesting. This is the first time we're going to look at how you go to the client with an issue. So, auditing and accounting estimate. Suppose management estimated the market valuation of some obsolete inventory at $99,000. This inventory was recorded at $120,000, which resulted in recognizing a $21,000 loss. Okay, so you guys remember lower of cost or market? What's lower of cost or market?
Market value. You can either judge it by using market value or the lesser of market value.
You were the first person who was ever able to answer that. I've been teaching this for like 6 years. Everybody says, yeah, that sounds familiar, lower cost or market, but they can't actually tell me. You're the first one who can actually tell me. Congratulations.
Thanks.
Okay, so right now, the inventory is on the balance sheet at 120,000. They do lower of cost or market calculations like they're supposed to, and they decided it's worth 99,000. Completely appropriate. So they need to write it down to 99,000. You guys remember what's the journal entry to write down your inventory? Anybody?
Fair value adjustment.
No, you don't need fair value adjustment. That's okay. Debit cost of goods sold and credit inventory for 21,000. Okay, so that's what the client did appropriately, but then the auditors obtained the following information. The inventory in question could be sold for an amount between 78,000 and 92,000. The cost of advertising and shipping, additional costs of inventory, could range from 5,000 to 7,000. So the client wrote down their inventory like they're supposed to, but then you, the auditor, made your own calculations, your own estimates, and decided it should be written down even more. Okay, so these are the numbers they gave us. The auditor estimates it's worth between 78,000 and 92,000. Okay, and it says the extra costs of preparing the inventory, advertising, and shipping are between 5,000 and 7,000. Well, let's just say it's 6,000 additional. So they have to spend an additional $6,000 to sell this inventory. So their estimate of the value of the inventory is a low range of 72 and a high range of 86. Okay. They would have to come up with an estimate. Let's just say they go right in the middle, and their estimate is 70. I'm just making that up. They would have to make an estimate, but let's say they did it like that. 79. So the client wrote it down to 99. You think it needs to be written down to 79. Okay. So this is our first lesson in this. You cannot make journal entries. It's the client's book. All you can do is suggest these were our calculations. We think you should write it down to 79. Since it's a judgment call, they may or may not agree with you. And then you decide. If they refuse to write it down from 99 to 79, are you ready to are you ready to say that inventory is fairly stated? That's your professional judgment. If you are suggesting the client make an additional entry, cost of goods sold 20, inventory written down by 20. And then you'll talk to the client about whether they're actually willing to do that. Okay. Anybody got questions on chapter 4? All right. We can get started at least on chapter 5. See how far we can get. All right. So as I've been saying, we have talked about internal control, but we've got a whole chapter that focuses just on internal controls. Okay. First, just some background stuff. A definition of internal control. It is a process effected by an entity's board of directors, management, and other personnel designed to provide reasonable assurance regarding the achievement of objectives in the following 3 categories: reliability of financial reporting, effectiveness and efficiency of operations, and compliance with laws and regulations. Okay, so that's a lot. A shorthand definition of internal controls. It's all the rules and procedures a business has in place to make sure the business operates properly. All the rules and procedures a business has in place to make sure the business operates properly. Everybody got that? Okay. Now we have here, there are 3 elements to internal control. They're all relevant, but I highlighted and bolded this one, reliability of financial reporting. That's because for our concerns as financial statement auditors, we are most interested in these internal controls, the internal controls that affect the financial reporting. These other ones are relevant, but they are less relevant to us. Our focus is the internal controls over financial reporting. Everybody got that? All right. Internal controls over financial reporting are the procedures in place to ensure that all transactions and events affecting the financial statements are executed properly. Client's control system produces the audit trail that the auditor relies on. This is the documentation of process from transaction to financial statements. Okay, we're going to use this term a lot, the audit trail. The audit trail are all the documents produced along the way that a transaction happens that provides the evidence for the auditor. Like I think we used this example before, right? You're in a big company, your department needs a new copy machine. Did we do that? Okay, so you guys remember that? What happens if you're in a big company and your department needs a new copy machine? What happens? You have to request a copy machine. You fill out a purchase requisition. That's the first piece of paper, the first piece of the audit trail. Okay, you got the purchase requisition. That's the first document. Then what happens? Someone has to approve you're buying it, some manager in charge, and they're either going to fill out their own form or what they might do is just sign off on your form. Okay, so that's the second piece of evidence. Now you have that document, and on it, you have a signature approving it. That's more evidence for the audit trail. Then what happens? Goes to purchasing. Purchasing, if it's a big enough item, they probably have to do competitive bids from a few approved vendors, and they are going to decide and order a copier. So there's a purchase order, another documentation, another document that's part of the audit trail, the purchase order. So now they've ordered it. What happens next? It'll show up, right? It'll arrive on your loading dock when it's delivered. It'll have a packing slip with it that says what it is. That's one part of the audit trail. There'll be a receiving clerk at the loading dock whose job is to pull up the purchase order, look at the copier, and say, yeah, one copier model XJC, one copier model XJC, okay, and fill out the receiving slip. We got what we paid for. That's another document in the audit trail. Okay. Now that you've received it, what can you do next? But not quite yet. First, before payment, you're going to make a journal entry. Now you can record an account payable, debit the equipment, credit account payable. That's another piece of evidence on the audit trail, the journal entry. And then finally, like you said, you're going to pay it. But when you pay it, the treasurer, whoever writes the checks, they are going to look at all those documents. It's called a voucher packet. We're going to keep coming back to that term. That's one you should know, the voucher packet. That's all those pieces of paper for a transaction stapled together. These days, it's probably all electronic, but it's easier to think of it. Actual pieces of paper stapled together, everything to do with the transaction. Okay, the treasurer is going to look at all of those. Okay, this was properly ordered. This was approved. We did competitive bids. We actually received the product at the right price. Okay, now I can pay it. The treasurer should not write a check until they see all those pieces of paper, everything was done properly along the way. Then they write a check. That is the audit trail. All those documents, also called the voucher packet, all put together showing how this transaction happened. And now you, the auditor, will come in. You're looking at purchases, and you're going to look at a bunch of voucher packets like that and confirm that everything was done properly. Okay, so two big terms we just learned, audit trail and voucher packet. Both of those will be coming back to a lot. Questions there? All right. Purpose of internal control testing. Good internal controls by the client allow the auditor to conduct fewer substantive procedures. Okay, that's what we learned in the audit risk model. That's one reason to test controls. They have good controls, less work you have to do. Okay, that's one reason to test controls. Another reason, it is required in all gas audits to test internal controls, and a separate audit of internal controls is required in PCAOB audits. Okay, that's one piece we left out when we learned the audit report for the PCAOB, the one that we memorized. An audit report now for the PCAOB will also include a paragraph at the bottom that says we audited the internal controls over financial reporting. Okay, that's part of Sarbanes-Oxley. It's required not only do you audit the financial statements, you also audit the internal controls. And that is on the audit report. Or it can also be you have an option. You can do a second report on the next page that says we audited the internal controls. But it has to be right there with it. So for all publicly traded companies, for any PCAOB audit, you have to do a separate audit of the internal controls over financial reporting. Now, for any audit, even if it's a gas audit, you still have to look at the internal controls. Everybody uses the audit risk model. You always test internal controls. And that's going way back. The new thing with the Sarbanes-Oxley law was that you have to prepare a separate report saying you audited the internal controls. You spend more time on it. But any audit, private or public company, you do look at the controls always. And you always have. That's not a new thing. Okay. Okay, assessing the control environment. So now we're going to talk about testing the internal controls. Okay, so for starters, what are some big picture things you're looking at? Thoroughness of formal control procedures. There should be a rule for every little thing you do. Okay, every form you have to fill out, every approval you have to get, it should all be written out and made clear to every employee how to do their job. You need to do it this way. If they don't have a whole lot of controls, that's a bad sign. Communication by management to employees, prioritizing control procedures. What does that sound like? Communication by management. Tone at the top, right? Management letting everybody know this is important. We care about these rules. We expect you to follow them. Quality of employees. Well-trained employees know how to follow the rules. Poorly trained employees don't follow the rules because they don't know them. Formal and informal environment, encouraging employees to report problems. This is about whistleblowers. Every publicly traded company has to have some method where employees can anonymously, safely report any problems. There are whistleblower rules. Okay? So if you as an employee see a problem, there needs to be some mechanism in place for you to safely, anonymously report, I think the guy at the next desk is stealing or whatever, without fear of retaliation. That's a requirement for a publicly traded company. They have to have, it's often called a hotline. It doesn't have to be a phone, though. It has to be some method to safely, anonymously report when you see problems. Okay. And then here, the last two, quality of audit committee and quality of internal audit department. They're supposed to be the people overseeing all the rules, the internal controls. If they do a good job, that's a good sign the controls are working. If they do a lousy job, if they're not monitoring the internal controls aren't going to be very good.
Would you only be able to really test the quality of an audit committee if you had a few years working for the same company?
That makes sense. I mean, the more you spend with them, the more you can. But there are a lot of things you can learn. You can just sit down with them, look at all their resumes. Who are these people? Are they former audit managers? Are they CPAs? And then just talk to them, see do they understand audit or they have no clue what you're talking about. There's lots you can learn right from a first meeting. Yes, we're going to get into that. Who can be on an audit committee? There are some rules. We're going to get to that. I forget when exactly, but we're going to get to that. Okay, and I forget if we mentioned the internal audit department should be reporting to the audit committee. In a good company, the internal auditors report to the audit committee, not to management, to give them some independence. So the internal auditors, if they see a problem, they're supposed to go to the audit committee. Like if they see management not following the rules, they can't report that to management. They're supposed to go to the audit committee so they have some independence. Oh, it's right here. It's the very next slide. There you go. What is an audit committee? It is a subcommittee of the board of directors. The rules are all members must be financially literate and one must be a financial expert. Okay, so that's the rules. Who can be on an audit committee? All the members must be financially literate and one must qualify as a financial expert. Okay, now you'll notice that's not really much of a definition. They want you to define that. Your company defines what does it mean to be financially literate? What does it mean to be a financial expert? And then you meet those expectations. The reason they're so general about it, they originally, when they came up with these rules, they thought, well, will require everybody to be a CPA. And then somebody said, does that mean Warren Buffett isn't qualified to be on an audit committee? They said, yeah, you're right. So we'll just go with these more general definitions. Okay, so you decide what are the qualifications to be on your audit committee, and then you meet those qualifications. We already talked about their job. They are responsible for hiring, firing, and coordinating with the auditor. They're who the auditor reports to when there are problems. And they are supposed to be supervising the internal audit department. Everybody getting this? Okay. Okay, now let's get into some details. What should controls look like? Control procedures are the policies and procedures that help ensure that management directives are carried out. You can put them in a few basic categories. Physical controls over the security of assets, so things like barcodes on the inventory and stuff like that, or having them in the secure warehouse with security guards, this kind of thing. Physical control over the assets, that's an important internal control. Segregation of duties. You guys heard that term before? Anybody? What is segregation of duties? Right. Right. To prevent people from covering up for themselves, you should separate out the duties. Basically, you can think of it, everyone should have someone looking over their shoulder. Everyone has somebody looking over their shoulder. You segregate out duties so that nobody is doing so much that they can cover up their own mistakes and their own fraud. Okay, information processing, that is getting approvals and authorizations. So like we said, before you buy a copier, you can't just go out and buy a copier. You have to get approval from a purchasing manager before you can buy it. Okay, so that's also a part of internal controls. You have to get permission to do things. And then finally, performance reviews. That's where you sit down with your employees and say, we like the way you're doing your job here. You could do a little better here. Do you understand what we want you to do here? Just check in with people, make sure they know how to do their job. That's also an important part of internal controls. Make sure everybody knows how to do their job. Okay, the principles of internal control. Three big things. Establishment of responsibility. A control is most effective when only one person is responsible for a given task. Okay, establishment of responsibility means there is always somebody in charge. There is one final authority on everything. That's how you make sure everything is done consistently. There's one person who has the final authority to say, okay, this is right. Okay. So every task should have somebody you can identify as being the final say on it, someone in charge. That's an important principle of internal controls. Every task has somebody in charge. Segregation of duties. We just said we're going to talk more about it in a second. Related duties should be assigned to different individuals. So everyone has someone looking over their shoulder. Documentation procedures. Companies should use pre-numbered documents and all documents should be accounted for. Okay, this is a really simple one, but it's an important one. Pre-numbered documents. All documents should have a number printed on them. So for example, you're an auditor going through the purchase orders. You're looking through them and you see that number 17 is missing. Now you know there's a missing purchase order you need to follow up on. What happened to this purchase order? If they weren't numbered, you wouldn't know that one was missing. So really simple, but really important internal control, pre-numbering all documents. Okay, this is important. Segregation of duty. So we're going to talk about it in more detail here. So ideally, there should be four people involved in every transaction. Somebody authorizes the transaction, like you can buy a copier. Somebody records it. You have a bookkeeper who does the debit inventory, credit accounts payable, or not inventory. In that case, we said equipment, debit equipment, credit accounts payable. You have a bookkeeper separate who does that. Third, custody. You have security guards at the warehouse who keep control over all the assets. And then finally, reconciliation. That's somebody like an internal auditor who checks that all of these steps are being done. Okay, separate people doing all of these things so that nobody can cover up for themselves. The example I like to use, my first job in accounting when I was still a student, I was a part-time accounts payable clerk at this small retail design firm. So this retail design firm, they would get supplies like the fancy pencils and paper that the designers needed. So the bills would come into me, the invoices, we owe money for this. I would get the approval from the actual designer, said, yeah, we ordered that and we received it. Okay. And they would sign off on it. Then I would take that invoice and I would make a journal entry in the system and I would put it in the file. Then every week, my boss, the CFO, there were really just three accountants, but he was the guy in charge. So the CFO would come to me and say, we've got $10,000 to pay our payables this week. Pick out the $10,000 in invoices that are most important to pay this week and give them to me. So I would pull out the actual invoices, $10,000 worth that were most due, put them in a little manila folder and hand it to him. He would go over all of them and sign the checks. So I had access to the records. I'm the one who did the journal entries and had the invoices. So if I wanted to make up a fake vendor, write up an invoice and put in a journal entry, I could do that. But I didn't have access to the checks. He wrote the checks. And before he wrote a check, he would look at the invoice. And especially since this was a small business, he knew all our vendors. So if there was some vendor he'd never seen before, he would say, who are these people? And he would look into it and find out that it was a fake vendor. So I couldn't steal from the company because I didn't have access to checks. He had access to the checks, but he didn't keep the records. I did. So if he wanted to write a check to his wife, he could do that. But when somebody like an auditor was going through the records, they would say, what are all these checks written? There's no documentation behind it. Okay. So I couldn't steal from the company because I didn't have access to the checks. He couldn't steal from the company because he didn't keep the records. Okay, that's segregation of duties, each of us looking over the other's shoulder so that neither of us could steal. Now, like we said, ideally in a big company, there would be 4 people on every transaction. We couldn't afford that, but we were still doing segregation of duties. Okay, everybody feel good about that? That's a really important thing we're always going to be looking at when we're looking at an example company's internal controls. Is there good segregation of duties? That's going to be one of the most important things you look at. Yeah, that's good. Okay, so we have when we come in next week, we start at 7 p.m. Everybody has a lockdown browser. You get on Canvas, 20 multiple choice questions over chapters 1 through 3 in Module C. Okay. Remember what I said about the exams. The first thing, you guys let me know. The first thing on the exam, it's what I talked about in class. If I didn't mention it in class, it's not on the exam. Okay, so when you're studying, emphasize what I talked about in class. The textbook is good backup, but if I didn't talk about it in class, you don't need to know it. And there will be a couple of questions on the handouts. I told you you don't have to memorize the whole handout. You need to know what I talked about with the handout. So just go over what I talked about, but there will be a couple of questions on the handouts. Okay. When you're studying, you have any questions, you can email me during the week or come by my office hours. Okay. And that's all we'll do next week. We'll take the exam 7 to probably 8:15, and then we get out early for that week. Okay. Yeah, we're done at 8:15. You can leave when you turn in the exam. Anybody got any questions? All right. Thank you, everybody.